Good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder and this is BRN AM for Friday, October 16th, 2020. And here are our top stories. Banks take a brighter short-term view, and is the white-collar recession over? Well, joining me now to discuss this and more is Devin Banerjee. He's Senior Financial Services Editor for LinkedIn. He's also the editor of the This Week in Finance newsletter, which of course you can find on the LinkedIn platform. Devin, thanks so much for joining us on the program this morning.
Absolutely, Jeff. Always good to join you.
And what I love about your segment in particular, and I love all of our contributors, of course, but we get to recap what happened this week in finance. It's something that you've been doing for a long time, and we get to do it on the program. So I know you wanted to talk about short-term bank earnings. What's going on there?
Absolutely, Jeff. I'll go through those short-term numbers, as you mentioned, and then we'll get into the longer-term implications of the numbers of the management commentary. But let's start with this strong kickoff to the earnings season by the financials. The big banks, JP Morgan, for example, the number one U.S. bank in size, seeing profit almost double quarter over quarter, booking just $611 million in loan loss provisions. I use the word just because that's down from $10.5 billion the previous quarter. Similar story at other banks, Citigroup provisioning $2.3 billion for loan losses. That's down from $7 billion. Goldman Sachs provisioning about 1/5 of the reserves for loan losses that it had previously. Similar stories at Bank of America, Wells Fargo. And let's get into what this really means. So, of course, well, actually, just in the short-term numbers, a couple of big drivers there we should touch on. Two of them are real strength in the trading businesses of these banks. If you think about the volatility we've seen over the course of this year, but also in the third quarter, that's really helping drive revenue, especially to the bond trading desks at these companies, but also the equity trading desks. Strength in the investment banking divisions, equity capital markets, debt capital markets, M&A. If you think about all the IPOs we've seen, again, as I mentioned, equity capital markets, a lot of that business has been strong. M&A activity is starting to pick up as confidence creeps back into boardrooms, into C-suites. But let's get into those longer term implications of the numbers and the management commentary. We have to talk about these loan loss provisions. I went through some of those numbers. Those provisions have come way down in the third quarter from previously, and that really points to optimism for the future, right? Now, a lot of people picked up on the fact that, yes, the third quarter money set aside came down, but these banks really did set aside a lot at the end of the first quarter and in the second quarter. JP Morgan, for example, now has in total about $34 billion in reserves for potential credit losses. But listening to the management commentary this week, Jeff, a lot of them are looking at loan delinquencies remaining quite low, helped by all of those lender forbearance programs that you and I have talked about, helped by government stimulus that has kept consumers' wallets, I wouldn't say strong, but stronger than they would be without those stimulus measures. And then some nuances in the management commentary. And a lot of that was about how high uncertainty remains going forward. A lot of people picked up on the comments by JP Morgan's CFO, Jen Piepszak, saying uncertainty remains quite high, and these with these loan loss provisions, the bank is prepared for it to just be a delay of credit losses rather than changing the outcome of credit losses. So JP Morgan is now expecting some of those charge-offs in its consumer loan book to pick up maybe in the second half of 2021 versus the first half. So it's kind of kicking the can down the road, perhaps. Not surprising that a lot of these executives called on government figures, policymakers, lawmakers to continue fiscal stimulus, monetary stimulus, especially on the fiscal side, to help consumers, help consumer wallets and household finances remain strong through this huge economic downturn.
Yeah, I was going to ask you about that, Devin, in terms of the fiscal policy. And as we're recording this on Thursday, well, now afternoon Eastern time, I don't think that we're anywhere closer to a fiscal stimulus. But let me ask you this, Devin, about interest rates. We've had a Fed change policy, in terms of their approach to managing the interest rates, the lending rates, et cetera. What does this mean for banks, or are there implications here for banks in terms of what actual interest you're getting if you're saving more? Because that's part of, the banks are there to lend money. You talked about some of the loan losses. What's this all mean in terms of the long term?
Yeah, it's a great question, Jeff. I would say banks are focused right now on just preventing those loan losses. In terms of revenue, or what's called net interest margin at banks, which is the spread they're earning on what they can lend versus what they're paying us in interest on our deposits. I mean, that kind of revenue has dried up quite a bit given the Fed policy lowering that benchmark rate, which leads to a lower cost of consumer borrowing, which is lower revenue to the banks. So, and I should just mention, I don't cover the banks extremely closely, but it has been a storyline over the course of this year and last year that net interest margin revenue has been declining. And so the real strength in these numbers has been more recently, as I said, in the trading businesses, just the volume going through these desks, given the market volatility, especially the bond desks, and that investment banking revenue, that advisory work for equity issuance, IPOs, debt issuance, and M&A. It's also important to note, Jeff, that these numbers overall would actually be a lot better if these banks weren't mired in so many scandals right now. A lot of people picked up on just the hit to the expense hits that these banks have been taking due to scandals. So Wells Fargo in this most recent quarter took a nearly $1 billion hit related to that fake account scandal, the fallout from that scandal. Citigroup had higher expenses related to the recent $400 million fine by U.S. regulators for widespread risk management failures. JP Morgan took a charge to help cover that $920 million fine for rigging commodity markets from 2008 to 2016. So even though the top line figures and the net revenue, the net profit figures have been quite good, those numbers would be even better if these banks were not involved in so many scandals. And
you really can't put a measure, Devin, on, this is more rhetorical, you can't really put a measure on lack of trust and what that actually means to some of these earnings. Well, Devin, I want to take a quick break. When we come back, we're going to talk about whether the white-collar recession is actually over. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
The windows on our homes, they protect us and the ones we love, but they do much more. At Renewal by Andersen, making your home more comfortable is at the center of every window we make. It's why we custom build our windows in America and install them in as little as 1 day. It's why we build our frames with exclusive Fibrex composite material that's 2 times stronger than vinyl. It's why our glass helps keep your home warmer in winter, cooler in summer, and quieter all year long. It's why we stand behind every window with a 20-year limited warranty. Why not help lower your energy costs while giving your home and family the best? Call 1-800-835-6525 to schedule a free in-home consultation. Buy one, get one at 40% off with this special offer. Plus, get special financing with no money down, no monthly payments, and no interest for 1 full year. Renewal by Andersen, the better way to a better window. Call 1-800-835-6525 now.
Welcome back. We're talking to Devin Banerjee of LinkedIn. Devin, thanks so much for staying with us this morning.
Absolutely, Jeff. Happy to.
So as I said in my lead-in, one of the trends that you're tracking this week is whether the white-collar recession is actually over. A lot of interesting numbers coming out of the BLS and other websites. What can you tell us here?
Absolutely, Jeff. We've been featuring some super insightful data from the website tracktherecovery.org, which is taking a lot of those official data sources that you mentioned and tracking this economic recovery. And what's emerging, and you and I have talked at length, which is a very important topic about this K-shaped recovery, but looking at professionals in this country specifically, there is this white-collar recession, if you will, that has largely ended, and a blue-collar recession that is not only largely continuing, Jeff, but actually getting worse. So according to tracktherecovery.org, as of September, just last month, the employment rate of Americans earning more than $60,000 a year had actually rebounded to just within 1% of where it was pre-pandemic. Effectively, the employment rate, or the flip side, the unemployment rate, is basically back to where it was for white-collar workers, those earning an annual income of more than $60,000. For those with annual incomes less than $27,000, the employment rate was 17.5% lower in September than it was pre-pandemic, and today it's down about 20%. So there's this huge bifurcation, which, yes, you and I have talked about quite a bit, Jeff, but this is putting kind of some real numbers around it, and that human element of what people are earning and just how bad they are faring. The key differentiator between these two groups has been the ability to work from home. There was just a fantastic large Washington Post feature about this divergence between people who can, like you and I, candidly, Jeff, right now, who can easily work from home digitally over technology, and those who, to pay the bills, they must go to work physically. Theirs is work that cannot be done from home. And so, for Americans earning less than $50,000 a year, just 18% of them are able to work from home. You compare that to, again, those of us, Jeff, who are easily able to work from home, it's quite stark. And one interesting implication for this that we've seen in the financial services area has been some actually kind of rare recent criticism of the Fed chair, Jay Powell. Last week, Jeff, Powell was speaking at the NABE virtual conference. That's the National Association for Business Economics, and he was really pressed on the question, how have the Fed's policies impacted wealth and income inequality here in the U.S.? And Powell's answer really disappointed a lot of people. He said it's really not, the Fed policies are really not affecting inequality here in the U.S. A lot of people saw that remark as quite disingenuous and quite surprising, given how much Powell, as you and I have covered, Jeff, how much he has talked about the challenges of especially of low-income Americans during this pandemic. A lot of people pointing to the idea that it's really just a fact that more than 80% of the stocks, are held by the top 10% of U.S. households, and the Fed's policies in terms of buying financial assets, supporting financial assets, are going to benefit those top 10% of households here in the U.S. So it was an interesting remark. We've seen some interesting, again, rare criticism. To Powell's credit, as you and I have covered, Jeff, he has tried to engage more everyday Americans with the Federal Reserve. He's talked more about the human toll of this downturn, the human toll of unemployment and poverty than really any other Fed chair in recent memory. Under his leadership, the Fed has leaned headfirst into topics like racism and sexism. So, he is aware of these topics, but that was an interesting fallout last week from his speech.
Maybe it was off his game a little bit. We'll give him a little bit of a break, but I think you bring up some look, we've talked about there are over 100,000 businesses, I think, is the number that I last heard, that have shuttered and have not reopened or have closed permanently. The majority of Americans are working in small businesses. I'm thinking like hair salons, delivery drivers. I mean, those are people that have to to your point, do their job, go out, steel workers, people like that are doing important work, but actually physically you have to be on a building to weld or put steel up. I mean, you can't do that remotely. So, there's clearly work that has to be done. And, yes, I think that a lot of Americans on the white collar, quote unquote, white collar side have certainly seen a ramp up or going to get back to some normal. They were not really adversely impacted by this. What we really need to focus our efforts on is, one, about financial literacy. We've talked about that regularly, getting people to have bank accounts, be able to use financial systems and understand what they're doing. And then we do need to continue to have this conversation about what are you worth in terms of the skill set that you have, and are you being compensated in a way that is commensurate with your skill type and what you have grown? Because you can have a great living doing, you don't have to be a white collar worker. You can have a great living. You should be able to have a great living doing anything that you put your mind to and have the skills for.
That's absolutely right, Jeff. I totally agree. It's also worth just looking under the hood of these numbers, as you and I just did in this segment, because we see these top line employment or unemployment numbers or income numbers, and we talk about this quote unquote recovery. And actually, there were some real interesting comments that we featured on LinkedIn, Jeff. Johanna Grush, who I think is at Bain & Company, she said, we talk about this quote unquote recovery, but it only deserves that name if one excludes all low to medium income employees and medium to low income zip codes, because otherwise there is no recovery, as you and I just covered. Andrew Waitman said, those of us in digital and professional occupations should consider ourselves enormously fortunate. We should be grateful, and we should consider how we can assist those who are enormously impacted in industries that we all value, but to your point, have to show up in person for work. And so, again, just going into the nuance and looking under the hood is really important for all of us who are trying to parse and understand these headlines and this news, to realize that there is this bifurcation and this divergence, and there are people really in pain, even as we talk about this quote unquote recovery.
Yeah, and going back to what we talked about at the top of the week with Natalie Walters, not-for-profits do a tremendous amount of work. They've been hit exceptionally hard, and so is the private sector. And by the way, the government sector, the public sector as well. So a lot of work to be done, and let's hope that policymakers, both at the state and local and federal levels, continue to work together, that's the key word, to try to improve things for these folks as well. And we do our part too. Devin, always a pleasure chatting with you. Thanks so much for the Week in Finance segment. I love talking about these important topics, elevating them up, and I'm really appreciative that you come on each and every week. Thank you, and have a great rest of the weekend.
Absolutely, Jeff. Take care.
And that wraps up this episode of BRN AM. Have a topic of interest or someone you think we should talk to? Then drop us a line. And don't forget, for all the news in retirement, markets, technology, personal finance, so much more, check out our daily newsletter, The Morning Pulse. Don't forget, we're back again tomorrow for BRN Weekly. We've got a very special guest, and we'll be taking a look at some of our best segments for the week. You're not going to want to miss it. And before I say goodbye, I want to say happy birthday to my younger brother, my only brother, Andrew. He's turning 46 today. Andy, always a pleasure. Best of luck. Love you, brother. So until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited? And do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.